Good morning, and thank you for joining us for this portfolio update on the Amati AIM VCT. I'm Colin Thompson from the Amati sales team, and updating you today, I'm joined by Paul Jordan, David Stevenson, and Gareth Blades from the investment team. Firstly, Paul will look at the performance of the portfolio over the period since our last update, giving an overview of how the portfolio is evolving. The team will then review the themes that we believe will drive performance over the long term, giving stock examples to illustrate the diversity of businesses within each theme. They'll then look at the new investments made and the positive and negative contributors to performance over the past year. Next month, we're holding our VCT AGM. It's on the 15th of June, for those of you who can make it along to the Barber Surgeons Hall in the City of London. We'll also be live streaming that event on the day, and you'll be able to find the link on our website. In any case, we hope today's presentation will give you a good insight to the positioning of the portfolio. Just one thing to mention, the Brighttalk system allows you to put questions to the team, so please enter them on the webinar page as they occur to you. With that, I'll hand over to Paul.
Brilliant, thank you, Colin, and good morning to everyone joining the call. So, this is the graph of the performance over the last 13 years, and as you can see, the last year in particular, and a couple of years actually, have been pretty painful for venture capital investing. And the AIM market makes that very transparent, and there's a sort of immediate impact. I suppose standing back from what's happened here, it's in some ways a phenomenon of what the extraordinary times of the pandemic, where the economy shut down, but then there was a huge amount of printing of money, and that created a sort of splurge of money with ultra low interest rates that went and found out all kinds of new enterprises. A lot of it pointed at big new investment themes. We're going to talk about the energy transition type theme later. Huge amount of money, capital has got into that. Most of the that money's had a difficult time, and it takes a while for these, when you get a big sort of printing of money like that, it takes a while for this all to wash through. I think standing back from it, we have to kind of look back at, well, what's the long-term trend here? Have these opportunities really gone away, or is this just really the market blowing hot and cold? As if everyone who's been involved in investing in small companies knows, the market can go from incredible highs to incredible lows, and it feels like at the moment we're much nearer the latter. And hopefully this is a time when some good opportunities are going to appear in much sort of colder market sentiment conditions. So a big drawdown, it's happened before. The last really big drawdown we had was 2008. That one, the great financial crisis, which was really a liquidity crunch driven crisis, was over pretty quickly. When you look back, it was unbelievably severe at the time, over fast. This one's, I think, going to take longer to get over. It's some of the issues that are causing the drawdown are just slower moving, but nonetheless, having thought quite hard about the portfolio over the last week or two preparing for this, it's clear that that there have been some big drawdowns in these companies, but in many cases the opportunities remain intact. And that's just the nature of stock markets. When things blow off, as they have done, we have to really work out, well, where's the long-term value going to be, which opportunities, or maybe we got wrong, and which ones we've got right, and where there's still plenty to come back and lots to go for. So that's what we're going to try and explore a bit in this presentation. One thing I can say here is that the dividend policy of the VCT is designed to carry through the ups and downs, and it's designed to be consistent. So in good and bad years, we pay out the same level of dividends, which is targeted at a percentage of the year-end NAV. And the idea is that in big up years, the dividends well covered by the profits, and in down years, it's the opposite. But it's consistent, and we recognise that a lot of VC investors really, invest in the asset class because they like that consistency of dividends. Clearly, the quantum of dividend goes up and down with the NAV, so it will be lower going forwards, but the percentage of NAV remains the same. And I think that's an important characteristic of the product. This is the top 10 holdings, how they stand at the end of April. There have been some quite big changes. Again, those of you who've known us for a long time know that we tend to be very long-term investors in our portfolio. I think it's one of the things that a VCT can do, almost uniquely in the market. We can be very long-term investors in these companies, and one of the results of that is that this end of the portfolio, the top 10, tends to be dominated by some pretty mature companies where we've held them for a long time, and they've gone from being the very small size of company that when they're VCT qualifying, when we can invest in them, to being really pretty large enterprises. And the most prominent now by quite some way is Keywords, and clearly the big turn in market sentiment and market conditions has impacted some of these, and it's not been equal, but Keywords has been incredibly resilient, and as a result is now easily the largest holding in the portfolio, and is one that we remain very optimistic about. It's become one of, if not the largest outsourced services provider to the video games industry, and this is an industry which has quite consciously formed outsourcing strategies over the last decade, and Keywords is the mirror to that desire of large companies to outsource services, and they've expanded a range of services they provide really very significantly. They're a global operator, and that's very important, that they can provide these services all over the world, so that a developer, say in the States, who doesn't want to have operations all over the world, can localize their game very effectively using Keywords, and they continue to acquire effectively. It's not easy to acquire businesses at the rate they do. It's an impressive feat, but it's been a successful formula and continues to be. And then, a lot of these names will be very familiar to our viewers here. Learning Technologies has had Learning Technologies, GB Group, Maxite, Polarian. These are all companies that have been in the top 10 for quite a while. They've all had a much more difficult time than Keywords over the last year and a half, for different reasons, and we'll touch more on those later when we go through the portfolio. But nonetheless, the top 10 remains quite dominated by some pretty mature businesses, and that's part of the strategy here for managing the risks in the portfolio. And one thing we've said for a long time is when the way the VCT rules work is that when we make new investments, we know we're having to take pretty significant risk. It's the nature of what we're being asked to do. It's what the scheme's really all about. And that's why there's very significant tax breaks from Treasury for investment in VCTs, because they want to support new ventures, and there's an equity gap, which is the theory behind why the tax benefit is given, and that equity gap is there because the risks are significant. But nonetheless, these businesses that we're trying to back here, the intention is that we're trying to create companies that can face into some incredible opportunities that are opening up with new markets, and the great sort of transition that the industrial transition that's represented by the desire to lower greenhouse gas emissions, for example. That's an incredible opportunity, but it also requires significant risk taking. And again, we'll talk about that later on, about how we've been faring in that kind of sector. This is another way of looking at the portfolio, and this is really by looking at longevity, market cap, position size. We call this our bubble graph. And the size of the bubble is the size of the holding, and we've labeled the top 10, I think, here. And you can see some of these holdings. The very oldest one now is more than 20 years old. Many are over 10 years old. There's a whole clump here with the keywords abiodynamics. That line is now 10 years old. But there's also a whole bunch of new bubbles in the past 3 years. And so this is the kind of distribution in the portfolio that we try to maintain, where we have a balance between more mature investments and the newer ones. And recognizing that these newer investments are going to take some years to really mature and get where we hope they're going to get. It's good to see that one or two of the newer investments have made it into the top 10, and Arrigo is the newest one. David will talk a bit about that later on. We tend to also look at how the geographical distribution looks by revenue in the portfolio, and it's one significant feature really of the portfolio over the last few years, and this hasn't really changed. I wouldn't say that it's been very globally diversified, and that one might think it's a VCT, it's going to be quite UK company dominated. You might expect that the revenues would be just heavily skewed to the UK. In fact, it's interesting that it's not really the case. This is at 42%. It's a very similar kind of exposure. In fact, it's very even slightly lower bias towards the UK than our small companies fund. And we sort of value that global diversification. I think that's a strength. It's a good sort of form of risk reduction, really, to be globally oriented. The sector weightings have changed a fair bit over the last year, and you can see dominated by information technology, which has always been the case. That's, if anything, risen a little bit. Healthcare really has declined quite a lot. This has been one of the most difficult sectors over the past 18 months. And we're going to talk about this, but it had I suppose, a bit of a golden period during the pandemic. And in hindsight, it's one could say, well, that just got overheated. It's always been a difficult sector, really, because the kind of investments require such longevity and so much so much capital in many cases that the market will go through phases when it can provide it and phases when it can't. And then when you have this kind of much colder phase that we're in, the longer term analysis of the business is prone to getting thrown out of the window and replaced by much shorter term views. So this has been probably our most difficult sector, and it's shrunk in size therefore, and then a good balance across the other sectors. We tend to be in companies which are intellectual property rich. That's just the nature of, I think it's part of the nature of VCT investment, and that's there's no accident that that's the case, which means that when we get things right and companies perform as we hope they will, they've got high barriers to entry and high margins because of that underpinning with really differentiated intellectual property. So we're going to talk through some of the themes, and I'll bring in David and Gareth to help me out here on these slides. The first theme, digital technologies. You can see that this is our biggest sector, includes some of the most mature holdings in the portfolio, keywords, GBG, Accesso, LTG, Learning Technologies. These are very mature companies. And as I was saying earlier, keywords held up, been incredibly resilient. The other ones had a more difficult time, all for different kinds of reasons. But the key theme of the more mature end of this market is just derating. And in some cases, businesses facing headwinds and seeing downgrades. But the most significant theme has been derating. Learning Technology actually had a pretty good year last year, and we're going to look at later on at how the earnings progression has actually been pretty positive in that company. But heading into more difficult climate in the US, the market's pretty more skeptical about its ability to achieve organic growth. Craneware is a very long-standing holding. Back this with IPO, I think in 2007. That's selling from UK software development into the US hospital market, and the US hospital market's been just under a lot of pressure in the last year. So we've seen the business slow down, but nonetheless it remains a company with a big opportunity ahead of itself, and really the number one in its sector. Has a very dominant position, really. And that's similar of GBG as well, where the earnings growth has really slowed down, but it has a very dominant position. And one of the themes, one of the aspects we've been talking about in relation to the Small Companies Fund quite a bit in the last 6 months really is the amount of money that's sort of sitting in private equity and sitting on sidelines. And we know that the UK stock market is really pretty trawled over by potential take private buyers. And we certainly think some of the more mature names in our portfolio are kind of potential candidates on that kind of list. Not that we really want to see these things go, and it's you know, and of course there's no, there may well not. It's anybody's guess which ones where the acquisitions come. But I think we're at that sort of value end of the market ranges where these things become a lot more attractive to potential buyers. And I'm going to bring in David here to talk about some of the newer holdings in the portfolio in this sector.
I think the key message we want to get across with this slide is the very diverse range of end markets that we have access to through these investments. Paul's mentioned some of the names that you may well be already aware of, that larger holdings and been presented before. I'm going to mention here a few names that are more recent investments or have been smaller positions in the portfolio but are performing really well. And one of the examples of the latter is Solid State, which has been in the portfolio for 10 years, but has grown very nicely through a combination of organic growth, structural growth in its end markets, but also through selective acquisitions. Solid State's involved in microelectronics supply and design. It covers computing power and communications markets, selling into defense, energy, power generation, aerospace, medical, industrial, transportation, you name it, right across the microelectronics universe. And those are markets that are experiencing quite significant structural growth, basically as industry, manufacturing, and key utilities become more digitalized. Another newer name, in Silica, and I would point out that in Silica is going to be presenting at the AGM that Colin mentioned at the beginning. So if you can make it along, you can hear more about in Silica then. And Silica is involved in specialist chip design and manufacture, ASICs, which stands for application specific integrated circuits. These are very niche semiconductors as compared to the more commoditized ones that supply consumer electronics markets. Again, in Silica involved in a range of different end markets: automotive, industrial, satellite, healthcare, and as Paul mentioned earlier, companies with IP in Silica would certainly qualify from that point of view. Like Solid State, in Silica is not involved in consumer electronics, which is the more commoditized end markets for these sorts of companies, and a market that has rolled over as consumer demand has suffered headwinds. Cordell is another more recent investment by the fund. Cordell is involved in transport infrastructure management. It basically offers digitalized surveying of rail network infrastructure using laser scanners, which are mounted onto trains, onto rolling stock, and this technology replaces manual inspections of railway networks, which is absolutely crucial from an ongoing performance and health and safety point of view. So manual inspections are being replaced by much higher resolution data and analysis. And the compelling nature of what Cordell offers is reflected in the fact that they have contracts with both Network Rail and Amtrak in the US, which for a company of its size, access to key infrastructure like that is very significant. North Coders, another more recent investment in the fund, is involved in IT education. It basically provides courses for coding for novices and also junior engineers who want to either reskill or upskill. They're providing courses in very high demand areas such as software development, data engineering, and soon there is further money to launch courses in cybersecurity, software testing and cloud. As I say, these are heavily in demand courses as the economy becomes more skilled in IT, and the employment success from people using North Coder courses is extremely high. pass back to you now, Paul.
Great. Yeah. Thanks, David. Just one on a sort of small note, there's 3 holdings here: Netcall, SRT, Quicksent, which a couple of years ago went through quite difficult times, and actually these holdings are really getting on the front foot and starting to go into growth mode again, and that's good to see. And so there's always some, while the general theme of the market is pretty negative, in a portfolio you always hope that some holdings which are managing to go the other way, and that those 3 are definitely doing that at the moment.
And sorry, Paul, I should also mention to the listeners that North Coders will be at the AGM as well next month.
Yeah, thank you. Okay, we'll go now and look at the healthcare sector. I'm going to bring Gareth in here to talk about it. I just want to say that this is an area which has been pretty painful for the fund, and the majority of these holdings have fared pretty poorly over the last 18 months for different reasons. We could say we were maybe in hindsight guilty of not taking enough money out of this sector when possibly we could. As I said at the beginning, that generally reflects we have a pretty long-term mindset when we make investments. We think that's an important part of what a VC does. And some of these holdings we think have really good potential still. Others, it's they've got some problems to solve, and it's a slightly mixed picture. And I'll bring in Gareth to just sort of talk through some of these holdings.
Thanks. So, we have a diversified and broad set of healthcare holdings that cover service providers, medical devices, analytics, and drug development. And as Paul has mentioned, healthcare has been a pretty tough place to be recently, and certainly in the services sector at the early stage. Those companies that are focused on preclinical or early clinical services have noted significant headwinds, with a very short time frame from customers that might be pausing or even cancelling work. And this has been an issue not just for some of our VCT holdings, such as Fusion Antibodies, Aptima, and more recently Maxite. It's been reported by much larger global companies as well. And it's been caused by essentially a tighter funding environment and end customers prioritising their pipelines, and more often than not picking those later stage assets that are closer to launch. And there are signs that some of this is normalising, but it's still a very tough environment out there. And then shifting to our holdings, so Korea Medical is a medical device company which is focused on a portfolio of FDA approved advanced energy endoscopy instruments, and it completed a significantly oversubscribed fundraise in February this year, which ultimately allows it or ultimately funds it to profitability, allowing it time to drive user growth as well as increased usage, while in parallel continuing the development of its partnerships with several robotic surgery companies. Intelligent Ultrasound is a medical device company as well, which is focused on a suite of ultrasound solutions for both medical training and AI-powered image processing. It completed a fundraise in November of last year. And the training side of the business has been trading very well. It sells into the NHS, but also internationally, and it's benefited from a growth in ultrasound imaging that occurred during the pandemic. And on the AI side of the business, it has a coveted partnership with GE Healthcare, which has incorporated some of the AI modules into its ultrasound machine portfolio. And bearing in mind that GE is the largest ultrasound machine manufacturer globally, and it's also selling the intelligent ultrasounds modules through its global sales force. So there's great potential there. And then moving on to Polarian, which I'm sure many of you will be familiar with. It's focused on its FDA-approved medical device, XenoView, which is a lung imaging device for ventilation in patients who are 12 years and older. It's had very well publicised issues with the FDA, which unfortunately delayed the approval timeline multiple times and thus delayed their commercialisation activities. And it can't be overstated, really, the impact that this has had on the company, not just on the obvious things such as its cash levels, but also, simple things that you do as you move towards commercialization, such as attract talent. And really, it's about 18 months behind its original plan. And as you would expect, as active managers here at Amati, we're staying very close to the business and continue to engage with it on commercialization. And then finally, moving to Aracor, which is a drug development focused company, focused on reformulation of existing drugs, which tend to be lower risk than de novo drug development. And large pharma and biotech come to Aracor as an expert in reformulation, and they can improve the characteristics of drugs. So things like absorption in the body, half-life, and stability. And a lot of excitement has been generated by Aracor's in-house insulin assets that offer advantages over existing formulations. And these have shown very promising results, but they're still in early stage studies. It also completed an acquisition of a company called Tetris Pharma that has the UK and EU rights to an injectable product called Agluo for the treatment of hyperglycemia in diabetics. And while that might seem slightly tangential to the core business, it actually allows them to offer additional services to its customers, such as biotechs that might not have their own UK and EU sales force and the associated logistics that go along with that. And with that, I'll pass back to Paul.
Sorry, thanks, Gareth. Yeah, the final theme we're going to look at here is environmental technology and services. And this covers a wide range of different types of business and activities. So one or two of these are relatively mature companies, and Dave's going to come and talk about those. Some others are developing new products and services, addressing just various different aspects of what often gets called energy transition. That's generally how we refer to it. But to bring about energy transition, as in changing the way we operate and reducing our huge dependence on fossil fuels, is going to require a massive industrial revolution in the next 20, 30 years. The more you think about that, the harder it is to imagine, and it's a very, very profound kind of change. And there's a number of new businesses obviously starting up to tackle just niche particular aspects of that. And as you might expect, we've been thinking a lot about this sector and opportunity, and trying to find some businesses which we think can succeed in doing that. And I'll just talk about a couple and then hand over to David here. Syet is one that you might have seen present at the AGM last year. It's a business focused on a new design of electric motor, and particularly one that's suitable for electrifying the two-wheel market in Asia. And really thinking about the Asian market, where millions of motorbikes and two-wheel vehicles, light vehicles, are sold every year. It's a huge market for motors, and Syet's particular design of motor, which is kind of pancake shaped, is just ideally suited to that two-wheel market. And having said that, the company, when it floated, had a very successful debut on the market. It's then found life tough. It's had some delays, some business opportunities been chasing outside of that Asian market have not gone to plan, and so the shares have really come down a long way. But we do, still very much expect that this business should be able to deliver on this the plan it has to scale up a business delivering drivetrains, not just motors, but the whole drivetrain into this Asian two-wheel market. And so, we remain hopeful that in the longer run, that investment's going to be good for the portfolio. There's two other things for me. CPH2 was maybe a good illustration of just how difficult it can be to really invest in new technology in this space. It's a company with a new design of electrolysis plant, and electrolysis is has become a bit of a holy grail in energy transition, because electrolysis is when you break down water into, and you create hydrogen, which you can then use as an alternative power source to natural gas or other fuel sources. And there are various other companies on the market that have raised a lot of money for electrolysis. There's a huge amount of demand, and there's not really a good solution yet that everyone's buying. Generally, right now, people are buying a relatively old technology, but there's a big opportunity for somebody to come along with a better one. CPH2 are targeting that, but so far it's just all been delays since we've invested. They reached some technical problems which have taken quite a long time to fix. But nonetheless, their partners have partnered with a large German engineering business who's just ready to manufacture this product as soon as the design flaw is solved. And we're hoping that this is the product's going to be launched before the end of this year. There's a big prize there, but there's also a risky journey. And there's finally, for me, Manufacture 2030 is the newest holding in this group. This is a co-investment we've made with Maven VCTs in a pre-IPO stage company. It's a high growth business. It's providing a software platform to really large enterprises who have really big supply chains, where they've set targets to reduce their carbon emissions from their products. And what Manufacture 2030 gives them is a way of actually delivering that and managing it with their thousands of suppliers. And so the idea is the suppliers sign up to the platform at the request of the large enterprise, and then the platform itself gets to know what their business is like, what their emissions are like, what their plan is to reduce their emissions, and then it's not just about reporting, it's also then about suggesting the programs that other companies have done to reduce their footprint in a similar situation. So it's, if you like, also a knowledge sharing platform for really hundreds of different engineering projects that can be applied to different parts of the supply chain to lower emissions. So it's in an interesting space, that business, and it's early days. We've just made that investment. And with that, let me hand over to David to talk about some of the other names in this sector.
For all that these environmental markets are relatively immature, we do have examples in the portfolio of companies that are highly profitable right now. A couple of the names you'll have seen from the top 10 slide earlier. Water Intelligence and AB Dynamics. Water Intelligence is involved in water leak detection, remediation and repair. It services both residential households, but also commercial and municipal markets. It does swimming pools, it does stormwater drainage, it does plumbing repairs. It's a franchise business model operating mainly out of the US, and currently has over $50 million in revenues. So a highly successful growing business in an environmental field. AB Dynamics, you may well be aware of, specializes in automatic driver assist systems, ADAS, the sort of things that annoy all of us when we're driving our new cars these days. It's also involved in simulation technology, and basically its hardware and software are facing full on to autonomous vehicle development, which all of the OEMs are very focused on, sitting alongside electric vehicle technology as well. AB Dynamics has £80 million GB of turnover. A name that you might not be so aware of is Eneraqua, which is a relatively recent investment a couple of years ago. Eneraqua supplies heat and water systems for large buildings. It utilizes air and ground source heat pumps, which you may well have read about in the press. It doesn't do household. It focuses on multi-occupancy buildings, things like leisure centres, student accommodation, social housing, hotels, care homes, and its systems are basically there to replace aging heat and water systems, but also significantly change the carbon footprint of those systems by replacing it with air and ground source pumps. For all, this is a relatively recent debut in the market. It has approaching 50 million sterling of turnover. But there are earlier stage companies within this list as well. Origo has been mentioned already, very successful IPO, which is a relatively rare thing to say in the markets over the last year or so. It's a developer of patented autonomous vehicle technology. It sits alongside AB Dynamics, but it actually produces, it's an engineering company, it actually produces the vehicles. Its first product, which is trialing at the moment, is luggage trolleys, which are used in baggage handling at airports, the sort of things that you see zooming around the aircraft as you sit on the ground. Origo's halfway through a 6-year project with Changi Airport in Singapore, which is one of the biggest global international hubs. The relationship with Changi is built on the fact that Singapore has a problem with labour shortage. They want to change the manually driven luggage trolleys to autonomous vehicles, but also want to electrify and transition away from what are diesel fueled trolleys at the moment. These are similar problems to global airports around all over. So there's a very significant global market potential for Origo if they can get this product successfully launched. Itaconix, briefly, is another more recent investment in the portfolio. Itaconix has developed natural polymers to decarbonize consumer products. Its first major commercial success is in the US dishwasher detergent market, where the phosphate ban in the US has encouraged manufacturers of dishwasher detergent to move towards a more natural form of ingredients. Itaconix polymers are used in products that are listed in all major retailers, Walmart, Amazon, etc., and they're moving now into penetrating the UK and European markets through Lidl and Tesco. So we'll move on from themes now to look at what we've been doing in the last 12 months. Deal flow has slowed a bit in the last year, and I'll speak more about that on the next slide, basically due to the turmoil that we've seen in capital markets more generally. But we've maintained a very decent investment run rate. This is not causing us any particular problems at the moment, and as you can see from this slide, we are still investing in the key themes that we've already mentioned. I should say that those 3 slides on key themes, they represent more than 50% by value of the overall portfolio. And you can see the ongoing diversity in the names of the companies that we're investing in here. Would highlight that healthcare is less represented in our activity over the last 12 months, and that reflects some of the difficulties in that sector. To put that into historical context, if you look along the top line, this shows the total number of opportunities that we've looked at in any one calendar year, going back over 10 years rather, and you can see a relatively sustainable level of deals, late teens through to 2021, where it really spikes up in terms of the opportunities we looked at, and that basically coincided with the COVID environment when companies were rushing to market to raise funds, in some cases for defensive reasons. And in that environment, an awful lot of healthcare proposals within our pipeline. 2022 has normalized, gone back to more like the normal run rate. 2023, we're running a little bit behind this. But you can see from the underlying number of deals we've participated in 2022, and we're early stages in 2023, we're managing a decent run rate of activity. I'll now touch on what's gone right and what's gone wrong in the portfolio over the last year. In terms of the contributors, the standout is Ideagen. Ideagen was a software specialist in GRC, which is governance, regulation and compliance, a very fast growing global software area. Ideagen was taken out in the last 12 months by a global PE house, HG, at a significant premium, and as a consequence, Ideagen became the largest holding in the portfolio, and contributed very significantly to the fund as a consequence. The same with hormone deficiency drug specialist Diurnal, the last name on this slide. This was bid for by a US industry peer, Neurocrine, again at a substantial premium. And whilst it's pleasing to report that holdings and companies that we have high conviction in are equally appealing to other parties, either corporate or private equity. This is probably the subject of a separate presentation, but it is concerning that some of these really high quality, very attractive compound growth companies are disappearing from the UK market, and it is a reflection of the undervaluation of smaller caps in the UK, and also the currency devaluation, which makes bids very compelling for both international corporates and international private equity. We've mentioned Origo, very pleasing to see that on the list following its debut in the market. It needs to back up that debut with progress. I had a call with the company yesterday, and I'm pleased to say that everything seems on track for now, but it's all about commercialization and converting that project with Changi into commercial scale in due course. And it's great to see that established investments like AB Dynamics and Keywords are continuing to contribute to the performance of the fund. Flip side of that, it's been a tough year, no question about it, for some of our holdings. We've discussed many of these names along the way. I think what to say in summary is that these companies experience both trading disappointments and also the very significant derating of smaller companies within public markets, and that double hit was a significant impact, which more than offset the positive contributions from the names on the previous slide. What I'm going to finish off with are some, I apologize, some busy slides, but what we're trying to show here is that we see upside in the portfolio, not just from the new investments, the earlier stage companies that we're investing in and how they grow and expand, but equally the undervaluation of some of the more mature and bigger holdings within the portfolio. These are slides that we take from our data platform Refinitiv. In each chart, we have a dark line graph, which is the share price of the underlying company, and the coloured lines are basically representing the earnings momentum for those companies, the pattern of upgrades and downgrades, both for the current year and also a year plus one out, so two graphs for each company. And over 5 years, these are all indexed back to 100. So what we would like to see here is a bottom left to top right trend line for earnings momentum, and matched by a similar trajectory for the share price. Normally, share price momentum tracks earnings momentum. Shares respond to earnings upgrades. But a feature of the last 2 years, and you'll see this on all the charts, basically from the pandemic onwards, is there's been a decoupling of that tracking. There's been a mistracking, in other words. And you can see here that for both, apologies, I seem to have jumped a graph. You can see here for both Craneware and Keywords that there's a fairly significant spread gap, air gap that now exists between the earnings momentum and the share price. This should be seen really as we think an opportunity for a near-term upside from these holdings as the share price reconnects with what's going on underlying earnings. But again, it's a feature of the significant de-rating that's happened in smaller companies of all sizes over the last couple of years. Same with learning technologies and water intelligence. The comment to make on water intelligence is actually quite interesting, that you'll see a period in 2021 where the share price momentum ran ahead of the earnings momentum. As a consequence, water intelligence, we would admit, got overvalued at that point, but the correction has been too far, and now the share price underrepresents the earnings momentum within the company. So on that point, I'll pass back to Paul for a wrap up.
Great, thank you, David. I should just say at this point we're very happy to take any questions. So do post any questions you have on the text input section. I think just in summary, many of the mature businesses in the portfolio have matured and are continuing to deliver growth. They've been derated, as David was just talking about. The earlier stage companies in the portfolio in some segments in particular, particularly healthcare, have suffered a good deal over the past year. We completely recognise this drawdown has been pretty painful for our investors, and for us as investors too. It is slightly in the nature of an AIM VCT that we're long-term investors. We like to hold these companies for long periods, and the market itself, can wax very hot and cold. And of course, not all the companies go to plan, particularly when we're investing at an early stage of somebody's vision and an idea for how to make a business. It's fantastic when those go well. Right now, we're in a very unforgiving environment if there are any problems with the business development. And of course, it's perfectly normal for a small company for not everything to go according to plan. The market sell-off is creating a good opportunity for new investments in terms of pricing, and these kind of periods when there's much less cash around, it's harder for fine companies to get backing. This is in many ways this is what VCTs are here for. We are through the cycle. We're kind of there every year. It's what policymakers tend to forget at the top of markets, when in 2021 they were asking themselves, do we really need VCTs? And I always think, well, actually, just wait till the next time the market goes cold and you'll remember why VCTs are required to provide this capital to small companies. And it's become much more difficult again to raise money. And that's why the scheme, both VCT and EIS exist. But it should be a good period for making new investments. We have a reduced pipeline of new deals, as David has discussed, but we're still seeing some good opportunities within the kind of themes that we are interested in investing in. And the VCT has the portfolio. We carry a lot of cash, which is actually a strength right now, given that the opportunity for new investments we think should be good, albeit the rate at which we can invest that money has slowed down. So yeah, but we think that's a strength. It also means that we have no immediate needs to raise further capital, and so there's two reasons why we got so much cash. One is we had some exits, and particularly IdeaGen brought in a lot of cash, and we have spent more slowly than we expected to the money we raised at the beginning of last year. With that, I will pass over to Colin to share some questions.
Great stuff. Thank you for that, Paul. We have a few. We had one on Polarian, which came through, I think, before Gareth talked about Polarian, but I don't know if there's any other comments you'd like to make on that stock.
I think probably Gareth
covered that.
Said what we need to say on it at this
Great
point.
stuff. Thank you very much. There was another one on an investor who invested in August 2021, and as you've noted, the share prices declined quite a bit since then. But the question was around, was the offer price artificially high at that point, Paul?
Well, artificial is the wrong word. I mean, the price, the market was high, and it's easy to see these things in hindsight. And of course, you know, in at any point in the market, you never know what's coming up. But you know, when this gets analysed in hindsight, you can see how the very low interest rates and the pandemic savings pushed the market up, and it wasn't, unfortunately, wasn't a sustainable level. I think there's an interesting question come in as well here about the strategy of the VCT. Has it served us well over many years, this idea of being a long-term investor and sticking with these companies and riding the ups and downs, or is an adjustment warranted? And actually, this is something we have thought collectively pretty hard about. You know, I think being self-critical, you know, it would have been better for us to be more active in selling holdings in 2021 than we were. We did sell some, and but selling more would have protected the portfolio more from the downturn that came. You know, we had the similar kind of thinking in 2008, and you know, it would have been a disaster to start selling stocks then. And even if we sold them in 2007, that also would not have been, in many cases, a good idea, because a stock like Craneware, for example, was still at an early stage. And yes, it halved in 2008, I think. I'm going to do testing my memory here, but then it went up very significantly from where it had been before, because it still had a lot of pent-up growth in it. And so that's really the hard judgment, is to sort of what's the trade-off between short-term problems and then the longer-term opportunity. And you know, once we sell these holdings in the more mature companies, we can never buy them back. Mm-hmm. And so the sell discipline in the VCT is very difficult to get right. And with you know, one reason why we didn't sell more was because we were thinking, well, actually, there's still a longer-term opportunity to go for in these companies, and we'll miss it if we sell out. And yes, we protect from a downturn, but then you look back and you say, well, actually, the downturn's been so big. It's been, you know, bigger than we were factoring in. So, you know, yes, it would have been maybe better to give them up. But that you know, that this is the kind of big dilemma we have. But it's right to be asking that question. And you know, I think probably our propensity to take profits in holdings has gone up from where it was a couple of years ago in response to that.
Great, thanks, Paul. Another question's come in. If the market pricing is out of step, are you considering putting the cash level to use by increasing investment in some of the holdings, given if there's an opportunity, I would guess?
Well, yeah, I mean, this is also a really important question, and it's important to kind of communicate the answer here, because yeah, in the VCT, although it has fantastic tax breaks, also has some very, very tough constraints. And one of those constraints is we can't really buy any of our holdings on the market ever. It's AIM quoted. We can't buy it. We could, if we wanted to, buy some fully listed companies, or we don't do that because we own the small companies fund. That's how we get our exposure to the whole market, or the broader market. But in the holdings we've got, just because they're cheap, we can't add to them unless they're in a position where they raise money. And then if they raise money, they've got to also then be qualifying still. And unfortunately, and because I would say that HMRC and HM Treasury have slightly reinterpreted the way some of the VCT rules work in a way that means it's less likely that companies stay qualifying for long periods of time. And in the past, as long as the company was under a certain asset level, we could be fairly confident of investing more capital into it down the road. Actually, what's happened in the last year or two is that the rules are being slightly reinterpreted in a way that makes that more difficult. So follow-on investing has become less predictable, and will probably be, you know, less of a feature than it has been in the past, unless, you know, this goes back the other way, and maybe get some reinterpretation of how this works. And for anyone who's interested, it's a set of rules around financial distress. And the way things are being interpreted is if a company's lost more than a certain amount of money over 7 years, then it can no longer raise money once it gets past a certain age, whereas that used to be assessed on an annual basis, is now assessed cumulatively. And this is pretty difficult for VCT managers, because obviously the way the rules work is we have to invest in companies that require the capital for their businesses, and therefore are probably going to be using that capital up in making losses. Not always, but quite often. And so now then that blocks further investment once they get past an age of either 7 or 10 years, depending on whether they're knowledge intensive. So you can see there's new complications come in here. But just because the market's cheap, we can't then just go and add to holdings we like the look of. And that's why we're reluctant to sell ones which we still like in the long run.
Great. Probably time for one final question, as we have only a few minutes left. What are the catalysts for or macro conditions for a real turnaround in AIM?
David, why don't you take that one?
I think, as Paul's already indicated, it's sometimes darkest before the dawn, and ultimately, if successful companies have been derated, then there comes a price point that is a catalyst for investor interest. We've seen over the last couple of years, not just in the VCT, but also across all our funds, our smaller companies fund and our AIM IHT service, that good quality companies are being bid for by a combination of corporates and private equity, both domestic and international. And we would like to think that the upside that is produced from deals like that feeds through into a reconnect, the slides I showed earlier, a reconnect to the share prices of some really good quality growing compounding growth companies that have been derated fairly significantly. That the market would generally, AIM market generally, would re-recognise the undervaluation of those companies. AIM has particular problems with daily liquidity. And the ability to move positions around. It's a little bit chicken and egg. That liquidity will improve if further investment money is put to work there. We're not really in control of that situation, but the ingredients are there for a rebound at some point.
Great stuff. Thank you very much for that, David, and thanks to Paul and Gareth for the presentation too. And thank you for your questions. That made it very, very much interesting to hear where you're coming from too. If you have any more questions, please put them to us. The members of the sales team are on the screen there, or you can find our details on the website. A few more have come through, and we will definitely get back to you. But for now, thank you very much, and we hope to see you at the AGM in June. Bye for now.